Good evening. Welcome to this wonderful IAS 41 again. We are talking about right now agriculture, and the topic is what is agriculture activity, what is harvest, what is biological transformation. Living animals and plants are capable of biological transformation. So certain common feature to such diverse activities. Which diverse activities we are talking about? Yesterday we had stopped at this point, agricultural activity, which will include livestock raising, forestry, annual or perennial cropping, cultivating orchard, floriculture, aquaculture. And what is common to all such diverse activities? Living plants and animals are capable of biological transformation. That means they can be changed, they can grow, procreate, okay, they can produce, they can degenerate. Biological transformation of these assets can be facilitated by enhancing, stabilizing the condition necessary. In order to apply this standard, one thing is that there must be management of biological transformation. Agricultural activity is the management of biological transformation. So how do you manage the biological transformation? Depending upon what is that item, you can provide them nutrient, fertilizer, you can provide the proper temperature. By controlling the temperature, you can help in biological transformation. You can provide fertility, light for the transformation to take place. That means here you are taking all the efforts to achieve the biological transformation. So it is management, man-made, human intervention is involved. Suppose you go and do fishing in ocean, that will not come under agricultural activity as per the standard, because then you are not taking any efforts to achieve the biological transformation. It is automatically happening. The change in the quality and quantity of transformation is measured and monitored as a routine management function. It is necessary to bear in mind the distinction between agricultural activity and other activities like harvesting from unmanaged resources. For example, ocean fishing. This example I have been giving again and again. If you do ocean fishing, it will not be an agricultural activity. This standard will not be applicable because there is no management of management of biological transformation. Or for example, deforestation, cutting the forest, is it an agricultural activity? No, will not be treated as agricultural activities. Classification of biological asset. Biological assets will be divided into two for the purpose of further accounting: consumable biological asset and bearer biological asset. So what is a consumable biological asset? They are harvested and sold as biological asset. They are harvested and sold as biological asset. For example, livestock for meat. Livestock like which animal I should say? Chicken. Is it right? For meat. Fish. Crops such as wheat or maize. They are directly consumed. Will they be covered by the standard? Yes. And there are bearer biological asset, like for example a plant or a tree which bears fruit. We don't sell the tree, we sell the fruit, okay. So that will be called bearer biological asset. They are self-generating asset like livestock held for milk. So cow would be a bearer biological asset. Cow is used for milk purpose. Grape vines are used for grape or fruit trees. Will this affect my applicability of the standard? IAS 16 says, IAS 16. What is IAS 16? Property, plant and equipment. That standard says bearer biological asset will come under IAS 16 because it is also similar to a property, plant and equipment item only. But consumable biological asset will come under this standard. Similarly, the fruits, the vegetables, the milk that you get out of this bearer biological asset, they will come under this standard. So accounting of fruit, vegetable up to the point of harvest will be under this standard. Now listen to this applicability carefully. Then I am going to ask you some questions. Okay. IAS 41 on third page of this chapter. IAS 41 is applied to consumable biological asset and agricultural produce up to the point of harvest, which means it is not applicable to bearer biological assets. It's not applicable to bearer biological asset, but it is applicable to the agricultural produce which may grow on the bearer biological asset up to the point of harvest. Any agricultural produce which is the harvested product of the entity's biological asset. Now I have removed the fruit from the tree. Okay. Falls under the standard only for the accounting purpose up to the point of harvest and not beyond that. Beyond that, which standard would take the charge? IAS 2. Okay. After that, IAS 2 will take the charge because it will become the inventory of that unit. Further processing of agricultural produce like grapes into wine does not form part of agricultural activity. Then it will become a different activity altogether, and therefore you are outside the scope of this standard. Okay, now answer this question for you. ABC Limited grows wines, harvests the grapes and produces wine. Which of these activities are in the scope of IAS 41? Three activities are mentioned here. Okay. One activity is growing wines. The second activity is harvesting the grape. And the third activity is producing wine. Which of these will fall under the scope of IAS 41? Grape wine. Will grape wine come under this standard? No. Grape wines are bearer plants, bearer biological assets that continuously generate crops of grapes, and it is covered by IAS 16. Okay. Then grapes will be covered by this standard, but up to the point of harvest. And wine will be covered by IAS 2. This standard does not apply to further processing of grapes into wines. Okay, now question in your book. Is managing animal related recreational activity agricultural activity? Animal related recreational activity like zoo? No. Why? What is missing in the definition of agricultural activity? Agricultural activity means management by the entity of the biological transformation and harvest of biological asset for sale or conversion into agricultural produce or additional biological asset. Is it happening there? No. So the answer is no. Managing recreational activity is not agricultural activity, as there is no management of the transformation of biological asset. Underline. Seems yes, but the answer is no, because there is no management of the biological transformation. Is the natural breeding of animals in zoos and game parks agricultural activity? Again the answer is no. There may be breeding of animals, some more new animals will born, but that is not management. For biological transformation purpose, it is incidental. Okay, so again the answer would be no. The natural breeding that takes place in animals used in recreational activity is not a managed activity. The main activity is entertainment of people by training the animals, not management of the biological transformation. So therefore additional animals born is only incidental to the main activity of providing recreational facility, but a managed breeding program, that means management takes all the necessary action for bringing biological transformation carried out to produce animal for sale, would be considered as an agricultural activity. Okay, one more question for you. Check whether in the given cases IAS 41 applies. Growing of plants to be used in the production of drugs, then development of living organisms such as cultures, cells, bacteria and viruses. Ocean fishing, this you can immediately answer. Ocean fishing is unmanned source. Fish farming, yes. What about this too? Growing of plant to be used in the production of drugs. Growing of plants means you have taken all necessary action, management to bring about the biological transformation. If a pharmaceutical or a biotechnological entity grows plant from which particular drugs are produced, that activity will fall within the scope of IAS 41. See, the definition of agricultural activity again is the management by an activity of biological transformation and harvest of biological asset for sale or conversion into agricultural produce. So this whatever produce they get, they make medicine out of it. So up to the stage of getting that herb or that whatever seed, flower, will become the agricultural activity. But what about the second one? Development of living organisms such as culture, cells, bacteria and viruses for research purpose. What is the objective? Research. Is it sale? Conversion into agricultural produce? No. Or into additional biological asset? Again no. So this activity will not come under agricultural activity. The development of organisms for research purpose does not qualify as agricultural activity, as those organisms are not being developed for sale or for transformation into another agricultural produce or any additional biological asset. If you remember that definition, then you will be able to check whether the given activity is agricultural activity or not. None of this is happening here, so therefore you will say it is not an agricultural activity. But if you want, you can add this answer also. If the organisms are being developed for sale, then the activity will be within the scope of IAS 41. For example, development of cultures for use in dairy product, for making curd, cheese, then it will be within the scope of IAS 41. The next question was ocean fishing, harvesting biological asset from unmanaged sources such as ocean fishing is not an agricultural activity. This was simple. No management of biological transformation is involved. But fish farming is management of biological transformation, because you will manage everything that is required, okay, for growth of fish. So managing the growth of fish for subsequent slaughter or sale is an agricultural activity. Okay, one more question. Is the produce or harvest from a biological asset inventory or another biological asset? produce or harvest from a biological asset, inventory or another biological asset. Another question is how it will be accounted for. That accounting part we have not yet covered, but briefly we will discuss now. Produce or harvest from a biological asset like milk, tea, leaves and lumber will be treated as inventory. Okay, and how it will be accounted for? It will be treated as inventory and IAS 2 will apply. Measurement principle is fair value less cost to sell. In case the produce is still growing or still attached to the biological asset, then it will form part of the value of biological asset. So you have to answer both. It may be an inventory item if it has been detached, that is harvested, but if it is still attached to the biological asset, then it will be still called another biological asset. Valuation principle is fair value less cost to sell. This example we have covered in your discussion about wine harvest, the grape and produce wine. Next paragraph, lease arrangement of biological asset. Which standard covers this? IAS 17 normally covers, but in this case there is an exception we have seen in the scope paragraph. The lessee and the lessor respectively would apply IAS 47 for biological asset on lease. Now we'll come to our accounting part. You are accountant. You are more interested in number crunching rather than just going through definition, scope, applicability. First is, what is the recognition principle? When will you show biological asset or agricultural produce in your financial statement? So as usual, some conditions are required to be satisfied, and these are the same usual condition for recognition of any asset. First is, the entity must control the asset as a result of past event. Either you have purchased it, you have produced it, you can enjoy the economic benefit, others cannot. That is the control. Past event means you have bought it, produced it, okay. And second, it is probable that future economic benefit will flow to the entity. So either you will consume it or you will sell it. So this will generate some economic benefit for the enterprise. And third is, this condition must also be satisfied here, because in case of agricultural produce or biological asset, calculating fair value or cost may be difficult. So they are saying that check one more condition: fair value or the cost of the asset can be measured reliably. So if these three conditions are fulfilled, then you will only recognize a biological asset or agricultural produce in your books. What about the measurement principle? So throughout the standard, the general principle would be fair value less cost to sell on initial recognition and on each subsequent reporting date also. So on each balance sheet date, you will see what is the fair value of that biological asset minus cost to sell. How much cost will incur to complete the sale? For example, you may have to pay brokerage, commission, okay. So remove that. Transportation, remove that. That will give you fair value less cost to sell. So this is about biological asset. What about agricultural produce? Agricultural produce harvested from the entity's biological asset shall be measured at fair value less cost to sell at the point of harvest. Right? So our standard ends as far as the agricultural produce is concerned up to this point only. Thereafter, which standard will take the charge? IAS 2 will take the charge on inventory. So what is common in both cases? Fair value less cost to sell. Fair value measurement shall be the cost at the date when applying IAS 2 or any other applicable standard. So this fair value will become the cost for the purpose of IAS 2. Now the next long discussion is on how to determine the fair value. There is a separate standard also on fair value, and that is your IFRS 13. Okay, so today we'll just quickly go through it because they will not ask you question on this theory part. Most probably fair value will be given to you. Your task will be only to calculate the final figures. Okay, so fair value reflects the market value, current market value. The best method of understanding fair value is to check what is the current market value of this item. So the contract price to sell the biological asset or agricultural product at a future date need not necessarily be equal to their current fair value. Contract price means the price at which you are going to sell is not necessarily equal to its current fair value. So which value you will take? Current fair value, not the contract price, because contract price may be more or less than the current fair value. Now there are total 7 methods they have given for estimating the fair value. Starting from 1, what is the sequence in which you will go? First priority, second priority, third priority, and then finally we'll reach the 7th number step. Okay, so the first priority is as usual where active market exists. What is active market? Large number of buyers and sellers. Is it right? Product is homogeneous, price is easily available to everyone. So in that case, the quoted market price shall be the appropriate price for determining the fair value. If the entity has access to more than one active market, then the most relevant quote will be adopted for measuring the fair value. You write here refer, because today we will not go into details of fair value. That is a separate chapter for discussion. What is the meaning of most relevant quote will be discussed in detail in IFRS 13. Okay, if more than one active market is there, then you have to see which is more relevant. Second, in the absence of active market, it is quite possible there may not be active market. Like for example, horses. Do you have active market for horses? Can I just go to a market and say, oh, give me this horse? No. The entity shall arrive the fair value by considering one or more of the following. Most recent transaction. See whether in the recent past any transaction of the same biological asset or agricultural produce has taken place. Yes, you can take that, subject to there is no major economic change between that date of transaction and the determination of fair value. Or if suppose not the same transaction, not exactly the same agricultural produce or biological asset, then market price for similar asset, if not same, similar, with necessary adjustment for the difference in quality. Or you can use sector benchmark. If there is any sectoral benchmark for a particular agricultural item, you can take that. Third is reasonable estimate of fair value. Fourth is sale in combination with other assets. Sometimes the biological asset may have active market only when sold in combination with other assets such as land. So you can sell this tree. Suppose this is tree and this is on land. Now you can't only sell the tree, you have to also sell the land. So in this case, an entity may use the fair value of the combined asset. These two together will be 200. Only land is 150. So value of this plant will be 50. Okay. So entity may use the fair value of the combined asset to arrive at the fair value of the biological asset. Fifth method is no active market in the present condition. Some biological asset may not have active market price in its present condition. In that case, the present value of the net cash flow expected from the asset discounted at pre-tax market rate shall be the fair value of the biological asset. So here they are asking you to use the DCF model. What is a DCF model of valuation? Discounted cash flow. If there is no active market, you have to estimate how much cash flow will be realized, discount it and get the present value. And next is where cost is deemed as approximate fair value. Cost may sometimes be the approximate fair value. Like you have bought a cow, for example. Then the amount that you paid for cow can be treated as fair value, subject to there is little biological transformation has taken place since initial cost incurrence. If you buy a cow at the beginning of the year on 1st April and it was a small calf, and by 31st March it has become a bigger cow, then there is a biological transformation. Then you can't use this cost for this valuation. Is it right? So assuming there is no or little biological transformation has occurred and the impact of biological transformation is immaterial, then you can take the cost. Is it right? And last is, suppose there is an inability to measure the fair value reliably. Now there is a presumption that fair value of a biological asset can be measured reliably. Normally we go with this assumption, and if you are an entity you will apply this assumption because you want to show the asset in the balance sheet. More asset you will show, more your net worth will be there, more your borrowing capacity would be there. So therefore theoretically a company may assume or may prove that there is no fair value. The presumption can be rebutted only at the time of initial recognition and for biological asset in respect of which market determined prices or values are not available and for which alternative methods of estimating the fair value are clearly unreliable. If suppose you are not able to demonstrate the fair value, you will not recognize that biological asset, and this can happen only on satisfaction of two conditions: initial recognition and there is no reliable method of fair value estimation. Then what will you do? If such be the case, the biological asset shall be measured at cost less accumulated depreciation and any accumulated impairment loss. So for such item whose fair value cannot be determined reliably, cost minus accumulated depreciation minus accumulated impairment loss. Nevertheless, if on any subsequent date biological asset becomes measurable at fair value, subsequently suppose you get the fair value, will you change the method of valuation? Yes, you will. Then such asset will be valued at fair value minus cost to sell. Now we will solve few questions also. But before that, what about the gain and losses at initial recognition? Gain or loss in initial recognition will be recognized in the statement of profit or loss. Is it right? A simple example of gain, we are going to solve a question also on this matter. Suppose a calf is born. Calculate the fair value less cost to sell. And that is your gain. That is your gain. Is it right? Biological asset account debit to profit and loss. Or suppose you bought some biological asset, say for example 4 lakh. You paid 4 lakh, but its fair value less cost to sell is 5 lakh. For example, its fair value less cost to sell is 5 lakh. Immediately you will recognize a gain of 1 lakh on the date of recognition only. Biological asset account debit 5 lakh, to bank 4 lakh, to profit and loss 1 lakh. Similarly, a loss may arise if point of sale cost exceeds the fair value also. On the loss we will take a problem printed below, so that time we will deal with the numbers. So what about the treatment of that gain or loss? Initial recognition or subsequent measurement? In this standard only one treatment, gain or loss will be transferred to profit or loss in the period in which it arises. Now some interesting question will come which you have never done in your life. Okay. Search for this question. Could you locate it? Yes. A farmer owned a dairy herd of 3-year-old cattle on 1st April 20x1 with a fair value of rupees 13,750, and the number of cattle in the herd was 250. What is the age of these cattle right now? 3 years. Take calculator, 13,750 divided by 250. So what is the average fair value per cattle? Is it coming to 55? The fair value of the 3-year cattle as on 31st March 2002 is 60 rupees per cattle. So its value has increased by 5 rupees. Okay. The fair value of a 4-year cattle, now after 1 year the same cattle will not remain 3-year-old. Just like you were not the same person 1 year ago, your age has gone up. So cattle's age also goes up to 4 years. The value of the cattle is 75 rupees per cattle. Calculate the measurement of the group of cattle stating price and physical change separately. Calculating the value of the cattle. So value of the cattle is simple. 75 into how many cattle are there? 250. So your valuation on this date was 13750. Take calculator, 75 into 250. Your valuation on this date will be 18750. 18750. So there is a change in the value. By how much? Is it 5,000? Is it 5,000? You have to divide this 5,000 into 2 parts. How much is the change due to change in price and how much change is due to physical change? Now understand, first price change. Something you will learn in, say for example, standard costing syllabus. Is it right? Same cattle, earlier it was 55, now it is 60. Assuming for the time being no physical change, its price have gone up by 5 rupees. So 250 cattle into 5, 1250. But the cattle has become 1 year older now. And in the market, a 4-year-old cattle is fair value of 75. So there is additional gain of 15 rupees. There is an additional gain of 15 rupees because the cattle which was 3-year-old is a 4-year-old cattle. So physical change is 15 rupees. So try 250 into 15. How much is that? Is it 3750? So that is due to physical change. That is because the age of the cattle has increased from 3 year to 4 year. Is it right? So how do you present the answer and identify if there is any error in the notes? First you write opening fair value 13750, increase due to price change 250 into 60 minus 55 1250, increase due to physical change 250 into 75 minus 60, and therefore fair value, take the total, fair value should be 18750, and you can cross check this number. It is simply 250 into 75. Just check 250 into 75. Is it right? Right. So make it 18750. Done? Okay. Try one more question printed just below that. XYZ Limited on 1st December 20x3 purchased 100 ships from a market for rupees 5 lakh with a transaction cost of 2%. Ships fair value increased from 5 lakh to 6 lakh on 31st March 20x4. Determine the fair value on the date of purchase and pass necessary journal entries. So tell me first, what will be the fair value less cost to sell on initial recognition? Fair value is 5 lakh, transaction cost is 2%. So fair value less cost to sell will be how much? Tell me. 4,90,000. Is it right? Yes. And what will be fair value less cost to sell at the end of the year? 6 lakh minus 2%. Because in order to complete the sale, you will incur 2% transaction cost. So initial recognition will be at 5 lakh minus 2%. How much is 5 lakh minus 2%? 4,90,000. And financial statement date, year ending date, it will be 6 lakh minus 2%. Tell me. 5 lakh 88,000. So what has been the change during this period? 98,000. Gain or loss? Gain. Okay. Now pass journal entry here and here. So in your book I have written the journal entry. On the date of purchase you are actually going to pay 5 lakh rupees. You are going to pay 5 lakh rupees, but you are going to recognize the ship only at fair value less cost to sell. That is 4,90,000. So therefore there will be a loss on the initial recognition. You paid 5 lakh, but you are recognizing the biological asset at 4,90,000 being fair value less cost to sell. Remaining 10,000 rupees expense on purchase in bracket SOPL. What is SOPL? Statement of profit and loss. Being biological asset purchased and recognized at fair value less cost to sell. At the end of there, what we will do? We will calculate what is the fair value less cost to sell. 5,88,000. Compare it with your book value 4,90,000. So the difference 98,000 is gain. So you will increase the carrying amount of biological asset by 98,000, and the contra effect to gain, change in fair value, will be written in SOPL. Right. So these are some simple examples. Now come to government grant relating to biological asset. First you should know that government grant is covered by another standard, IAS 20. Is it right? This standard only deals with government grant relating to biological asset. For other types of government grant, refer IAS 20. So government grant relating to biological asset and the biological asset are of two types: measured at fair value less cost to sell, and as we have seen in some cases they may be measured at cost also. Is it right? When fair value cannot be determined, then it can be measured at cost also. Now we'll come to biological asset measured at fair value less cost to sell. So first we have understood there are two types which are measured at fair value less cost to sell, measured at cost. Under measured at fair value less cost to sell, the government grant can be conditional or unconditional. Conditional will be you have to grow a particular herb for 5 years, otherwise you have to refund the grant. So that is conditional. Or unconditional, no conditional attached. So the treatment would be different for conditional or unconditional grant. If it is unconditional, no problem. Is it right? Government says we want to promote cow. Buy cow, get 10,000 subsidy. Immediately recognize in SOPL. Is it right? So if the grant is unconditional, the grant will be recognized as income when it becomes receivable. That is, all terms and conditions you have fulfilled. Grant can be recognized as income. And if a grant is conditional, then you will recognize it as income when the conditions are fully met. Underline, when conditions are fully met. Okay. Example of conditional grant. Example number 1 in your notes. If an entity is required to farm in a particular location for 5 years, what is the condition? 5 years you have to do the farming in a particular location and is required to return the grant if it is less than 5 years. Then the grant will be recognized as income only after the completion of 5 years. Till that time, the grant received or receivable will appear in your SOFP. Okay. But it will not be treated as income. After 5 years, you will transfer it to SOPL, Statement of Profit or Loss. Okay. Next example. Example 2. Suppose the attached condition is a grant of rupees 1 lakh will be given to those entities which will remain engaged in herb farming for 5 years. Grant is required to be returned if this condition is not satisfied. Now in this case, the grant will be recognized as income in the SOPL only after completion of 5 years and completing that herb farming for 5 years. But sometimes there can be some relaxation in the terms and condition. Same example continues, but it says the attached condition to the grant may allow retention of 25% of the grant after completion of 2 years of farming. If you complete up to 2 years, you can retain 25,000. If you complete 5 years, you can retain entire 1 lakh. 2 years are over. What you will do? Now you can recognize 25,000 rupees because that much amount is allowed to be retained by the firm. So 25,000 can be recognized as income. Next is government grant relating to biological asset measured at cost. So if the grant relates to biological asset measured at cost, then apply IAS 20. Go to IAS 20. Whatever IAS 20 will give you the guideline, you will follow that. Now we'll solve question number 7. It's like a small case study with lot of information. Okay. So one more question. Moon Limited prepares financial statement to 31st March each year. Okay, Moon Limited prepares financial statement to 31st March each year. On 1st April 20x1, the company carried out the following transactions. Purchased a land for rupees 50 lakh. Purchased 200 dairy cows. Average age on 1st April is 2 years. So after 1 year, what will be their age? 3 years. So right now their age is 2, but after 1 year their age will be 3. So while calculating their fair value at the end of the year, take the fair value of a 3-year-old cow, not a 2-year, because after 1 year they will move into age group 3. He received a grant of rupees 1 million toward the acquisition of the cows. Okay, some countries like cows too much. Okay, this grant is non-refundable, means unconditional, treated as income. For the year ending 31st March, this is our year ending date, companies incurred following costs: 6 lakh to maintain the condition of the animal, food and protection, 4 lakh as breeding fees. So this you treat it as expenditure. On 1st October, underline, between 1st October and 31st March, what is the gap? 6 months. 100 calves were born. This is full income only. Is it right? After 6 months, their age will become 6 months. So while doing the fair valuation, take the fair value of a 6-month-old calf. Okay, not 0. There was no other change in the number of animals. Very good. As of 31st March 2002, Moon had 3000 liters of unsold milk in the inventory. This will also be measured at fair value, less cost to sell. The milk was sold after the year end at market price. So till that time it will appear as inventory in the SOFP. Now in order to check your intelligence, they have given the information regarding fair value less cost to sell. Land 50, 60, 70. If nothing is given, which model you will take for valuation of land? Cost model. So we'll take 50 only. Newborn calves. Newborn calves per calf. 6-month-old calves per calf. 2-year-old cows per cow. 3-year-old cows per cow. Milk per liter. Now all these figures are not relevant in our answer. Here is the test of a student's understanding. Only with practice you will be able to get it. For example, for land IAS 16 will apply and we will follow cost model. So this 50 will be relevant. For the newborn calf, now they are 6 months old on the reporting date. 6-month-old calf value on 31st March is 1300. This is relevant. 2-year-old cow has become 3-year-old cow now. The cow which was 2-year-old at the beginning is now 3-year-old. So I am going to value them at 5500. And similarly the milk I am going to value at the rate of 24. There is no point in calculating 2022. There is no opening balance. Is it right? So you understand what I have tick mark on the screen. These figures will be relevant. Prepare extract from SOFP and SOPL. So how do we solve the problem? I will solve, you check. Okay, we'll go line by line. First format is SOPL, second format is SOFP. Start. Purchased a land for 50 lakh. Where will you write land? In balance sheet 50 lakh, or I will write all digits. So you will write 50 lakh here. There is no adjustment here. Then you purchase 200 dairy cows for 10 lakh. But the value of this dairy cow now is how much? 200 into, they have become 3-year-old, 5500. So I have to recognize the gain due to change in fair value. 200 into 5500 is what is their value right now, and I had purchased it for 10 lakh. So how much is the gain here? Haji, how much is the gain? Is it 1 lakh? 1 lakh. This way, first in the exam, first to draw the format, and then you will write down income, expense one by one. After that, they have written received a grant of 1 lakh. No, 1 million. How much is 1 million? 1 million is 10 lakh. Then 6 lakh rupees was to maintain. Okay. One more thing I should do. This dairy cow at the end of the year, we have to value it at 11 lakh. Second effect, valuation. What is the next cost they have incurred? Breeding fees. Breeding fees is 4 lakh. We'll write here. This is an expense. Then 100 calves were born. What is the value of these calves on 31st March? This figure will take 1300. Or you want to take this newborn 1000. If you take this is also right, but then you have to increase it by 300 in any case. So my total gain will be 1300 per calf. You want to write separately? No. One single line item. Very good. So first effect will be change in the fair value of newly born calves. How many calves were born? 100. Into directly 1300. 1,30,000. And 1,30,000 will come on the asset side also. Is it right? What is the next item? Milk. How much milk you have? 3000 liters. And what is the value you will take? 24. Just take, is it 72,000? And the inventory of milk will be here in the SOFP 72,000. Find out the profit or loss. So total income from this business is 13 lakh 2,000, and the total expense is 10 lakh. Oh, that's a good business. I should also start this business. 3 lakh 2,000. And total assets that you have of PPE item 62 lakh 30,000. Total inventory 72,000. Balance sheet is only an extract. SOFP is only an extract. So this itself can be a 10 to 15 mark question. Explanation for each item is printed below. Just read yourself quickly. No, read. And then if you have a query, we will discuss. For each item we have given the explanation. Now the last part of this wonderful IAS 41, disclosures. Most probably they will not ask you question on disclosure part of IAS 41. So I am going through it quickly and I will read some of the important ones only. So first you see mandatory disclosures. Gain or loss on initial and subsequent recognition of biological asset and agricultural produce at fair value less cost to sell. Second, description of each group of biological asset. Third, nature of activities involving each group of or each class of biological asset. Fourth is non-financial measures. Non-financial measures or estimate of physical quantity of each group of biological asset at the end of the period. Why they have used the word estimate? Sometimes it may not be possible to count. Is it right? and output of agricultural produce during the period. Method and significant assumption used in determining the fair value of each group, because finding fair value for agricultural produce or biological asset can be a challenge. Is it right? So you have to give the assumption that you have used agricultural produce at fair value at the point of harvest, biological asset. Then fair value less cost to sell of agricultural produce harvested during the period determined at the point of harvest. An existence and carrying amount of biological asset, underline here, whose trade is restricted, and those that have been placed as security for liabilities. This disclosure also you have to give. Those biological asset whose trade is restricted and those biological asset you have placed as security. You have taken loan against biological asset. Amount of commitment for development or acquisition of biological asset. Okay. So you may have an agreement with the government that you are going to develop or acquire a certain biological asset, and financial risk management strategies related to agricultural activities. Next is reconciliation. What is reconciliation? Opening to closing figure you have to reconcile. A reconciliation of change in carrying amount of biological asset between the beginning and end of the current period. Such a reconciliation will include: first, increase due to purchase or business combination, decrease due to harvest or due to classification as asset held for sale, gain or loss arising from fair value change, exchange gain or loss recognized, and other changes. This standard is over.